Hey traders, welcome to the next installment of the Forex trading series, and literally welcome to the second half of the Forex trading series. In this one, we're going to be touching upon support and resistance lines and zones, and we'll be talking about three main types that you'll be coming across. The first one would be the horizontal stuff, and we use two tools for that, which would be, the first one would be the horizontal tool on your platform provider. So for those that use MT4, it'll just be this one here. And we drop a line in where the market hits at least two or more points. Okay. The next one is, or the next tool for the horizontal support and resistance is where we're going to use our best friend, the Fibonacci tool. Right. So grab your Fib tool. And basically, we're going to be in line with our trading objectives, which would be a previous move, a previous high to low that's been created in relation to where price is right now. That's what we're trying to figure out. So what we do is either hit the high, say for instance, in this case, market's retracing back this way. So we'll do the low first, and that'll be the 100% line, and we'll draw this in, and we'll say, where do we think this market most likely is going to come back and bounce till? Right, so something along those lines, and we say, okay, our favorite, which is the inverse of the golden ratio, which you would have learnt about in the Fibonacci video, the previous one, and we'll just drop a line here and we say, okay, chances are market's going to head back down to this point here, right? And there's another way of looking at this as well, and we'll touch upon that once we go deeper into talking about fibs and the horizontal support and resistance, okay? So that's the first type, that's the horizontal one. The next type of support and resistance area tool type is dynamic. Okay, so you've got your dynamic support and resistance areas. What do we use for that? The tools we're going to apply to that is, if for our extents and purposes, will just be the EMA 200 and the EMA 50. Okay, there are indicators available that will automatically draw them in, and we did have one on our charts, which was the SHI True Channel, and for many of you, you probably do have that on your charts now, and you can, if you download the template off the website, then that will be a part of it. Do I personally use it? No. I think for all extents and purposes, our analysis will just be around horizontal, Fibonacci, EMA 200, EMA 50, and which then leads me into the third type of support and resistance, which would be the utilization of a trend line, right? So again, for those of you using MT4, it will just be this diagonal line here, right? So, and again, same principle with the horizontal one. It's where it's meeting two or more points, and we kind of just draw them in. Okay, and that we then utilize to say, if price comes and bounces off and behaves a certain way around those lines, that's when we kind of consider an entry. Okay, me personally, I'm not the greatest fan of the trend line. You can still use them. I still use them at certain times, and for me, it's if I actually see a nice trend that's happening, then what I can do is utilize this for one, to figure out where the market is going to break that trend, and then maybe continue on in the opposite direction. And this will make more sense when we do the Elliott Waves video. And two is where when market does break that that trend, it will come back to do a retest, and it's the retest off my trend line is where I will say, okay, now this market's going to start heading in that direction. Now, when I'm talking about retests, I'm also talking about this. Okay, say for instance, we were to follow, say, this. Or say for instance this one here. Okay, if we were to follow this main hit to the low here, and that we can apply that wick, that point, and we see where price has broken past this as well. So these would be our two main points, right? How I do the retest here is, and for those of you that are looking at this area now, probably starting to become familiar, it ties in with our patterns. Remember, a market structural behavior where the market is telling us that we're getting ready to move in a specific direction. What's the behavior? See this big gigantic M? So the retest here is where the market's trending and it's actually done its Elliott waves for our liking, and the market goes up. it initially breaks it, goes back up to do the retest before it comes down, right? Let me get rid of that so you can see that better. And that is a double top formation. That's what I generally use my trend lines for, okay? But besides that, I don't really bother so much about them, okay? Now, let's just have a quick look at what we've done in the series so far. And the whole idea behind that is that each video is compounding and adding or creating like a bigger picture. It's like a puzzle we're putting together. So eventually you'll see this overall thing and everything should just make sense to you, okay? The first one, the overall sandpit, what we're operating within. The mindset one, the second one is, in my opinion, it's that one's going to be priceless, because everything does come down to your unique understanding of your ability to do absolutely everything within the universe. You create your futures, right, or your future moments. So how you approach trading, how you approach that millimeter shift, how do you approach that actual shifting process is all entirely up to you. And so your mindset, your thought patterns, and how you clear them as well, how you can kind of reestablish a new program that runs you on autopilot, or how do you create a future that you truly desire, getting rid of all the blocks, right? That's going to cover that. That's absolutely important when it comes to training, because with many people, and I know this video here is centered around this one here, but the whole idea is to say, if you really want to achieve something, you've got to change the way you think, because how you're thinking at this very moment is creating the crap that you're living at this very moment, okay? If that doesn't make sense to you, you've got plenty of troubles. If you want to change your future, change your now. Okay, that's the kind of the variable that you can kind of shift, which will start creating a absolute new beautiful future for your liking. The stadium, something that you should all be familiar with by now. Where you operate, where you perform, where you play. You're an artist now. You're no longer just a trader. You're an artist. You're a performer, and every time you're in front of your charts here, you're performing. Okay, that's how you got to look at it. Very, very important. Within the stadium, we created objectives, right? Why you're trading and how you're trading. The main objective is to look at where price has been, and then where price is now, and where price exactly is in proportion to where it has been, right? We can then take those two pieces of information, put them together, and then project out as to where the market is most likely going. Where can it go? It can go up, it can go down, it can go sideways, right? So just off of that, we got a 30% chance of choosing the right direction. If then we start applying some degree of subjective forecasting to that, then we can increase our odds or increase our chances of choosing the right direction. Okay, what is subjective forecasting? It's a business term. Basically, it's where we're utilizing our intuition, we're utilizing some degree of experience, we're utilizing our knowledge, and combined all of that together, we're making some serious educated guesses as to where the market can go. So your 30% chances of winning now all of a sudden increases to hopefully 90 to 100% chance of picking the right direction. Okay, so that's what we're doing. What you see on your charts, and this is where support and resistance start to be applied, is what's also called in the business world regression analysis. Basically, we're taking sets of results, we're plotting them onto a graph and creating some sort of a graphic image for us, and then we're studying the unique relationship between them. Okay? Remember in the Fibonacci video, we came up with this idea of proportions, right? And that is that if you were to take different sets of results, what you'd find is that one set of results exist in proportion to something else, right? And when you know that the universe is kind of created in proportions and one thing exists in relation or relative proportion to something else, we can then kind of start studying the relationship between them to see if we can find something that's common to all of the different proportions. And with Fibonacci, we discovered that there is a golden ratio, the 1618 golden ratio, and the inverse of that, the 618 line. So that we can start to then apply to our trading and say, okay, If price is going to be at a certain point in proportion to a previous high or low, we can start applying our 30 seconds worth of attention span to that area, and then start applying our criteria, which is going to give us an entry point into that trade, ride it for 20 pips, and then go to the beach. Okay, so we could actually start doing that. Now, when just off the visual, you look at it and it starts to make sense that, hold on a second, you know, the market just doesn't move straight up or straight down. It moves in waves, right? That makes life easier for us, okay? If you understand that all of the universe moves in waves, then chances are the markets will as well, right? As above, so below. So when the market's moving in waves, it's actually also creating these invisible barriers, like these sandbanks where the market goes, hits, and then bounces off, right? When we're looking at it this way, it doesn't make sense. That we don't know why it's bouncing. Why did the market go up, hit that point, and then come back down again? Why did it do it here? Why did it do it here? And, you know, today's open. Market went up, end of New York. It hit this point and then came all the way back down again. So how do we know, or how do we begin to understand what unique relationship this point had with this sort of behavior? And the only way we can do that is if we start looking at the past. If we start looking at existing structures that the market's already painted, right? The footprints. So here's what we're doing. First rule of thumb when you're looking at support and resistance, or the utilization of support and resistance, is one, you know that market moves in waves, right? And it will establish, the waves establish a high and a low. So where are we looking to establish our support and resistance lines? And highs and lows, right? First thing. The second thing is to understand how these time frames work, okay? And the simplest way I can explain it is to say, that's the weekly chart. Thank you. That's the, all right, shut up. That's the daily chart. And so here, when we're in the daily chart, it will take, depending on what chart feed you have, 5 candles to equal 1 candle on the weekly chart, right? If you then go on to your 4-hourly chart, then you'll probably look to say that 1 hour candle here will equal 6 of the 4-hour candles here. Okay, so if we were to look at just that point from here to here, we should have 6 candles. See, 1, 2, 3, 4, 5, 6. All of these 6 candles combined will equal, well, these 6 candles here combined equals this one green candle that exists there, and so forth, right? So it's to say that 6 pieces of candle and all the movement that occurred within those 6 candles resulted in the creation of this green candle. It gave birth to it, and so forth. You're going down the line where that 1 hour candle here, so 4 of those 1 hour candles will equal 1 4-hour candle, right? That 24 of those 1 hour candles will equal the daily candle. So all of this here, these 24 sets of candles here that made that move last Friday, is that green candle. And when you start to look at that unique relationship that exists there, then you start to understand that as we go up our time frames, what we're finding is that the signal that we're getting on the higher time frames will be much, much stronger than the stuff you're getting in the lower time frames. The lower time frames are kind of just like the worker bees. The decisions are made on the higher time frames, right? So these are like the worker bees, and the more higher up you go, the more the market starts to make sense to you as to what it's doing. Is it bouncing off a critical point of, you know, Fibonacci 61.8 or 38.2? Is there a dynamic trend line that it's hitting, which in this case would be our EMA 200 on a daily chart or a 4-hourly chart, or even a EMA 50? Is it hitting one of those? Is there a structure that was established on a daily chart, and so that's the reason why the market is kind of all over the place on a 15-minute chart, right? Because you got to look at it this way. When you're looking at it from a daily chart perspective, we can say that, okay, the euro has been hovering up here for the last, when is this? Okay, since December till now, it kind of has been hovering around a certain point, okay, in comparison to the JPY currency pair. But if you're looking at it on a 15-minute chart, that just doesn't really make too much sense to anyone, right? It's just waves going up and down, up and down. Someone threw a rock in the ocean, and the market that rock created ripples. That's all we're looking at. But when you go up to a higher time frame, it starts to make sense. So the second rule really is that in order for you to establish really strong zones in the market to say, here's where I believe the market's going to retest, it's going to bounce off, it's going to behave in a certain way that's going to take my attention. Okay, it's almost like you're in a relationship and you're playing hard to get. I really want you to be in a relationship with the market, and I desperately want you to play hard to get. Okay, be arrogant about yourself and say, I'm too good for you, markets. You've got to kind of really play to my charms to be able to say, I'm going to pay any attention to you. So play hard to get. In this case, what we're doing is we're saying, we're going to look for areas within the daily chart where the market starts to hit an invisible wall, right? What is it exactly? Why does the market hit it? In my opinion, they're like sandbanks. So it's like, you know, when you're at the beach, there's massive waves coming towards you. We don't see the sandbank, but just off the behavior of the waves, when it kind of crashes and breaks, we know there's a sandbank there. So in the same way, we can't see, or we wouldn't have known that there's something up here, right? Market goes up, hits it, and then comes back down again. But is there a way to decipher, well and truly before time, as to the existence of a sandbank there or an invisible wall? Like, how do we do it? Besides opening up your third eye, there really isn't any other esoteric way of doing it. So here's how we normal people can do it. First things first, we look at just critical areas where the market's been hitting over and over and over again, and we grab our friendly horizontal line. We just kind of drop an average somewhere. Doesn't have to be at the top of it, doesn't have to be at the bottom of it. You kind of just drop it at the bottom somewhere. Okay, I don't know why I've got these lines here. Okay, and then the next thing you do is the same thing, the inverse of that. So, okay, we've got a resistance point here. We'll say, can we create more of a resistance zone? And we'll say, okay, if I moved it up slightly, then we've got this point, and we've got a whole heap of points that happened here, but all of these don't hit. So I can maybe drop another one in. At this time, we don't really care about where we're dropping it in, and that's simply because we're not going to be trading straight off of them. All we're going to be doing is observing, or let's say we're creating a focal point, and then we're going to come back to that point. So here, price is here. Of course, it's nowhere near here. We're way and truly off, right? About 389 pips off, close to 400 pips off. But what we're doing is we're just kind of analyzing the unique behavior of the market. We're dropping these lines in so that eventually, if price does reach those points, those be focal areas for us on a lower time frame, right? But when we're applying it to here, here's what I'm going to do. I'm going to jump in and say, okay, price has hit one of our dynamic trend lines. It's hit our EMA 200. Broke right past, did a retest. So, and then it went all the way back up, hit it, and then the next candles come back down again. So, for today, markets bounced off the EMA 200 and it's most likely coming down. Just off experience, and going back to subjective forecasting, just applying experience there, we're saying, okay, this could be a strong trend down. Could be, right? Because the combination of these three candles tells me a couple of things. One, this is an inside bar. Okay, this is inside the price movement of this high and this low of this previous candle on Friday. That's the first thing. And price on Thursday, price throughout Friday existed completely within the boundaries of this high and this low. Also, we've got our EMA 200 where price hit, and then today, almost immediately, price has fallen. Right? What could happen? Chances are maybe the market may bounce back slightly, create a bit of a wick by the end of day, or it could just continue going south. If it breaks this point and this point, we've got a very strong push that going south, right? That's what the daily chart's showing me at this stage. But what I want to know more importantly is that last week sometime, or in the last couple of weeks, maybe even a few weeks, the market established a low here and then established a high here. So what do we have? We've got an initial move, a high and a low. Let's start analyzing it. Okay, remember objectives, what was the previous move, which is in this case this one, where is price right now, and what's the relationship of where price is right now to where it's been. So we'll grab I'm going to grab my fib tool and say, because the market's retracing down, it's coming towards my 100% point, so I'm going to draw from the bottom up and go straight to the top. Okay, where is the market? It's hovering at my 618 line, right? That's critical. And for those of you that kind of see this, where price does break past the 618 line, chances are there's going to always be, not always, but probably 80-90% of the time, there's going to be a candle that is correcting this move here. So there'll be a retest, a corrective candle. And that explains this green candle here. What do I mean by this? Basically, it's this, that we have price at most likely, see how here price slowed down at 382 mark? That you will have some sort of consolidation, so candles will go sideways around those times, or if it hits our 61.8 line, say for instance that's there, you might get a wick, but the next candle might actually be a small candle of the opposing color. In this case, it's a decent sized candle, but it's still an inside bar. Okay, so it's inside the high and the low of this candle here. And then we wait for our confirmation candle, the next one, which is kind of coming back down again, which is this one here, to say, okay, this could be a strong continuation. Could be, right? So what we want to do tomorrow is come back and look at what the market may do. Now, for today, if it kind of flows in with our analysis, what we might get is that the market is most likely going to head down, if it does. And then tomorrow we do a slight pullback before it kind of continues going south. So on that pullback, we'll be looking for an opportunity. And again, this will come back down to how we analyze the market on an hourly chart and a 15-minute chart. So that's what I'd look for. And say, okay, this is a bounce off the 618 mark, right? Now, let me explain something to you guys that will probably make a lot more sense. First of all, let's go back to this point here. Now I remember why I had those lines drawn in. Okay, when we go back to, say, just analyzing support and resistance areas and zones and why the market's been to a certain point, right? What I'm going to do is I'm going to look at where the market bounced off here in relation to like previous moves. So I'm going to zoom out. I'm going to say price is down here right now, and how I'm going off of this is just this big green candle. Say for instance we're here, right? You come in on this day and you say there's a big green candle that happened that's completely engulfed this candle here. There's a bit of a wick of this candle higher, but it's engulfed it. And we're saying, okay, what's the previous move to where market is right now? We're seeing consolidation, so we'll say the big move that we're seeing is from here to up here somewhere. Correct? So we zoom out. And we say, okay, what was the previous move to this? And we say, okay, all of this is just in one region, so I'm going to take the most effective low, which is this bit here, and I'm going to grab my fib tool and just look at where price presently is in relation to all of this. So I'll grab my fib tool there, draw it all the way up to the high, right? And I can actually do it to this low as well, but personally, just through experience, I don't like doing it too much to massive wicks, right? But you could do it here, you could do it here, you could also consider the move from here, okay? And when I say from here, I mean here. But for my purposes, I'm just going to do it here. Okay, we'll do it here. Okay, you could do this point and this point. Now, I then go back to look at where price presently is, and I say, okay, that makes sense to me now. That market has hit my 38.2 line. So there's a chance that where this price has gone all the way up, it's consolidated, it's coming back, it's hit my 38.2, and chances are it could continue going up. That's going to tie in with Elliott wave structure. Okay? Again, that was going to make more sense to you once we get down to Elliott waves. But that could tie in with Elliott wave structure. So for our benefit, what we're going to do, I'm going to draw in a horizontal line here. I'm going to just drop that in. And say, for instance, none of this has actually happened, okay, to do with what we're doing right now. We're just at the beginning of this day. I'm also going to drop a line in at the beginning of this day here, which is this massive wick that we're seeing with a small body, get rid of my fib line, and then I'm going to jump onto an hourly chart to go find that. Okay, in real time, that would be just the far right, whatever's there in the far right. So that's where we would be. So here's where we're at. That was the market coming down. This is from here all the way up to here is that one green candle on the daily chart. Okay, this whole price movement here, and then we're at the very start of that next day. And so what we see, day opens, market starts to come down. For those of you that are in London or trade the London session, you'll get up and you look at this and you say, okay, market has come back down, and what I'm trying to figure out is, where is this market going now? Is it going to continue going south, or is it going to go up? So what I might do is grab my fib tools again. Remember our best friend, our Fibonacci tool. And we're going to say, okay, this is the absolute low here. Yesterday, it created a low and created a high. So I'm going to now draw in, sorry, my finger slipped. Draw in my high to low and low to high, sorry, low to high, to try and figure out to what point is this market going to go and then bounce off from. So we say, okay, price is here somewhere right now, and we'll look to see where our 61.8 lines are. And we're going to say, okay, that's where our 618 line is. I'm going to drop a horizontal line there. Okay. And I'm also going to say, okay, I'm going to drop a horizontal line at my 382. I'm going to get rid of the fib tool. Okay, I'm going to get rid of this one here, which was the 382 line from the daily chart, right? None of this has actually happened yet. None of this. Not even this, right? Hasn't happened yet. So we're up and we see this and we say, okay, notice how prices come back down, and in proportion to this move here, it's come and hit our 38.2 line. Okay? It's bounced off, created a nice wick off of there, and it's just bouncing off, and we're starting to see this behavior. And we're trying to forecast now as to where the market's going to head to. When we have done this analysis where we've applied our support and resistance area, right? So in this case, this is now a key support area for us. We're saying it's going to retrace back and it's going to bounce off a certain point. How do we know when to take the trade? Well, here's how we do it. The first thing is, you want to make sure that price does come and hit one of these points, right? But you don't take the trade as soon as it hits it. There's a lot of traders out there, you know, the ones that say, you know, you can't do 100% wins, you can't do 90% wins, you can only do about 70 or 80%, that sort of bullshit. When you hear that, those are the same idiots that are trading this, and they're saying, okay, when price comes and hits this line, I'm going to have a pending order somewhere here. I'm going to have a pending order up here that's going to say price is going to go up here, and then have a very tight stop loss, and then this happens, and they say, shit, I stuffed up and I lost that trade, and that's the reason why you can't have 100% win rates. Bullshit. You can. How we do it is we let the market do whatever it's doing. Remember, not too long ago I said play hard to get. All right, so you love the market, you just don't tell the market you're in love with it. So play hard to get, it's going to come down and it's going to behave a certain way. And then just before New York Open, it goes boom, right? It starts to behave again like a way that we're starting to recognize it. Okay, now let's jump onto it. Well, before we jump onto that, the key criteria for entry here would be where market starts to establish a pattern for us, a pattern that we like, a pattern that we're familiar with, and it's where the market just goes through a whole heap of trouble to prove to us that it loves us too, right? So remember, I've been harping on about this, where we have, and so many other people are teaching this as well, this is not something that's exclusive, this is something that is what the market does. We see patterns, remember, W pattern, M pattern. Sorry, that should just be one line. Okay, so M pattern, right? What is that? That's a double bottom where price comes down, hits it, goes up, comes down, hits it, goes up. This is a double top. Price goes up, hits it, comes down, hits it, comes down, right? That's what we're looking for. So once you've established your support and resistance areas and zones, you want the market to come back down and start establishing a pattern. Notice how it does. See how it comes down here, establishes a pattern, and then it goes all the way back down to do a bit of a stop hunt. It hits our 61.8 line, creates a wick, and then goes back up again, right? For all of us that are going to take an entry off this behavior here, where are we going to take that entry? Any guesses? I know for those of you that are savvy, have been paying attention, you already know. It's not here, it's not here, it's not here, it's actually at this point where you will consider it. But for us, when we know we're not going to be trading the end of New York, we're now looking for an entry point going into the Asian session. Okay, so it's where at the open of the Asian session, chances at some point market comes down, does another hit to the low before it strikes back up again, right? That's what we're looking for an entry, up here, not down here. Let the W formation happen. Let the market prove to you that it's absolutely madly in love with you and it's prepared to do absolutely anything you want it to do to be with you in that regard. So what we then do is we jump onto the 15-minute chart. We don't take entries off an hourly chart. We just do analysis of our hourly charts. Okay, where is that? Let me zoom out. There we are. So here's what we're doing. We already know of our hourly chart analysis that if we were just to redraw this again, the market's most likely going to come back to our 61.8 line. It does, right? And then we're looking at London session prior to that, and we say this is how it behaved. It broke the 200, went up, came all the way back down again, behaved, consolidated, I suppose. End of New York session, it bounces up. Fantastic. It does its thing, and then what we do is we say, okay, it's already started to bounce up. What are we waiting for? Two things. One is that you might get some sort of a hit early Asian session of a fib line. So this, say for instance, is our initial high. This is the low that we're getting, and it's just bouncing off the 23.6. Are we going to trade it? No, we're just going to observe the Asian session moves. Where do we trade it? Remember London Open? If prices behaves a certain way and it's given you some sort of an indication that it's moving to a certain point, we start to understand that it's most likely when this stuff happens off our 61.8 lines, where we've created horizontal lines. Remember, that was a point here where we established a horizontal line on a daily chart, and we know that we're looking for price to behave a certain way there. And then we went into a daily chart, and it started to show us that yes, there is a 61.8 line on a daily chart that it could come and hit, and it did hit it. And then we're saying, okay, now it's hit it. Is it behaving a certain way that we recognize? What's the behavior? We're looking for the behavior that's doing a double top or a double bottom, right? So it is. We're seeing that it does, and then it continues up. What's the next thing that we're seeing? We're seeing that with our dynamic trend lines, which is the EMA 50, we know that the smaller one moves faster than the bigger one. So in this case, the 50 is starting to go up. It's crossed the slower one. And we're saying, okay, fantastic. This market's doing something now. Where do we trade it? Where do we look for entries when we're trading? Open of New York, open of London, right? And then we say, okay, price is behaving a certain way. It comes back. It hits our EMA 50. And that's where we're looking for a possible entry. Okay, if it does this and just goes up, fantastic. But if it creates a pattern for us, remember in past videos I've said we're looking for price to begin behaving a certain way around our lines as well. Because right now, just of our analysis, we've applied two things. We've applied horizontal support and resistance. We've also, within that horizontal scope, we've applied the Fibonacci to establish more horizontal support and resistance areas and zones. But now we're tapping into more of like a dynamic trend line support and resistance. So this is where we say, okay, now just off this here, we can start applying trend line analysis. So we're saying, okay, market's going to come and bounce off a dynamic trend line. It does, and it's also creating a pattern for us. So where do we take our entry? Off this candle. Why this candle? See how this one here is just strong. There's a lot of volume behind it. It's engulfed all of this completely. So we say we're going to take an entry off the next candle. We're in Euro JPY. First candle gives us about 6 pips. The second candle, right at the tip brings us to about 19 pips, right? If you wanted to bank that, you can. But what we also know after all of this analysis, that the market's going to continue going up. But remember, when the market does move up, it will come back down, consolidate, and then what we're looking for is another push, right? Open New York. So you probably would have had to wait a while if you were waiting for that definitive 20 pips, right? I probably would have waited as well. Seeing this, I would have thought, okay, chances are this is going to continue going up. In this case, it didn't. It did come down. For a brief moment, you would have been out of the money, but you would have been roughly sitting comfortably in profit. Not comfortably, just reasonably in profit for a little while before the market moved up. So you would have been in that trade if you would have taken that entry here for an hour, 2 hours, roughly 3 hours before you would have seen your 20 pips. Or you would have seen roughly, well, actually, you know what? You probably could have hit your 20 pips just in these two candles. Okay, so that's how we kind of want to analyze and combine the two. For those of you that will use your trend lines, these ones here, would basically be how I would be doing it is that once you see this move, this kind of like a W formation happen where you want it to be, and then you get this point, I wouldn't take my trend line from here to here. I'd take it from here to and then go up. Okay, so where would I put it? I'll probably just average it to somewhere in the middle of this. And why do I do it here? It's because when we're looking at it this way, say for instance this is the W, right? When the market comes back down, it's going to go like that. That's what we're expecting the market to do, right? If you're doing it this way, you're probably going to be like, you know, your line will be drawn in maybe somewhat that way, and it'll be out with this. So you'll continually be readjusting this, right? So how I would personally want to do it, hold up, I'm still learning how to use this tool. So how I would personally want to do it is to have this market do this, come back down, do this, come back down. And what you'd find is that there's more of an accurate trend that happens off this mark. Okay, let's have a look at our charts to see if we're correct. Now, I chose this point here where it just bounced off, right? And then I waited for this point to happen, and then I'll draw this in and just kind of continue that down, right? Notice how price does come, it behaves a certain way, we've got a bit of a doji in the middle, breaks it, and then goes back up to retest. Right? It doesn't keep coming down, goes back up to retest. And why we wouldn't take the trade off here to do a short? Because we're already expecting after this cross here for price to bounce off our 50. Okay? So notice how if I was to extend this, how price actually does do the reverse and keep bouncing off that same trend line, right? I know the market's going up, so I'm not going to really be trading off of that, but that's how you can kind of utilize it to analyze it, right? Let me show you another example. So I hope we're all familiar with drawing in our support and resistance lines with higher time frames, and let me just show you another one, sorry, on daily chart. Let's look for something better. Previous structure is this sort of stuff, so horizontal stuff. Let me get rid of this. Is where we're just looking at this movement here, and we'll say, okay, there's a number of points that price did hit. What you can also do is scroll all the way back. See, no, I just dropped that in here, but if you were to go all the way back here, notice how price did actually respect that point. So that was back in, I think March. This is, the count is American time, so American standard. So that would be March of 2015. Notice how actually not March, sorry. That is December of 2015. And so price does come back November of 2016, almost a year later, and bounces off that same point again. So here's where you can start utilizing some of this. Go back into the past and say, okay, I'm going to drop that line in and see what it does. Let's also do this. Notice how there's a hit here, there's a hit here. Let's drop a line somewhere here. Okay. notice how market starts consolidating around that area here as well. Okay, let's go back and see what price did previously. Price hit it here, bounced off. Price hit it here, bounced off. Price hit it here, bounced off. Okay, there's a slight bounce off that area here that it did come down, bounce off here. Now, if you're looking at this and saying, well, it didn't exactly bounce off that exact same line, right? This is why you pay more attention to zones as opposed to lines. Zones are that invisible area where price can actually go to, but doesn't mean it's going to just, like, say for instance that's the line, right? Price is not always just going to go bounce off that and come back down. If it were to happen that way, it'd just be too easy, right? So what we're expecting is that we've got this line here, this invisible wall, which is kind of fluid to some extent. So price will go and it will bounce around it, right? It's like that. So that's what we start paying attention to. And when we say, okay, price has kind of hit our trigger point, we're now paying attention to what the market's doing around there. We just don't blindly jump into a trade. A little story I say to myself, this aqua line here is mum, this white line here is dad, right? So this is a little child, it's a baby. What it does is it's playing, it's misbehaving, it comes back, it will interact with mum, maybe it's hungry, might have some food, play around mum, and then at certain times we'll say, hey, you know, where's daddy? So I'll probably then go to dad, play around with him, do a high five or something, and then come back down, run around mum for a bit, and then continue playing. So that sort of behavior continues doing. Exactly the same thing applies to horizontal support and resistance lines, right? And it can also happen with your fibs. So you know, when we're at times drawing in our fib tool and we say, well, price doesn't exactly just come and just do something off the 61.8 line, it can actually go over it. That's okay. We just start paying attention to it when it's around there. So it could go up, it could go hit it, and do this before it comes back down. It's gone above it. It's between the 618 and 78.6 line, but it's just that area we're paying attention to the market. We've got its attention. It's almost like your kid, which is the market, is about to touch something hot, or it's on the edge somewhere about to jump off, and we're just kind of on edge paying attention to what this kid's about to do. All right, so something along those lines. Just be aware of that. Okay, and that's how you draw in. Do you need to be very specific? No. Do you need to go in and do this with everything on your chart? Absolutely not. Remember, the whole idea is to look at proportions. Where is price now, and what's the previous move? And where is the previous move in response to a move prior to that? Okay, so this would have been a previous move, and the previous move to this move would have been this move. So forget about price here. To what proportion of this is this move? So we can then apply fib to that as well and say, okay, here's the low, here's the high. Market came and bounced off our 61.8 line. All right, so it came down and behaved a certain way. And again, when we start applying this whole idea of the law of infinite proportions, and again, please don't go searching for that. I just made that up on the spot. It's kind of nice, right? But the law of infinite proportions kind of just says to us that everything within the universe exists in relative proportion to everything else. Shit, I should be a physicist. I might get a Nobel Peace Prize for that. Now, so when you see that behavior, you can start looking for entries in going in that direction. So draw in your support and resistance lines, then utilize your fib tool to see which proportion of that present move, which proportion of the previous move does the present move kind of sit with, right? And that's when we start forecasting and say, okay, if it's bouncing off the 61.8 line and then it does an aggressive move up or down in our favor, we'll say, okay, we're going to be jumping onto a lower time frame to see if there's an entry. And the entry will have its own established criteria, a M or a W pattern somewhere along those lines, an aggressive move in the direction that we'd want the market to trade in, maybe some candlestick patterns. It has to fit into our criteria of sessions, London Open, New York Open. And if we're getting those confluence of events around those times, and even on a lower time frame, if that bounce, that M or W is kind of happening off our EMA 200 or EMA 50, guess what? We're in the money. Okay, so that's how we do it. I think we pretty much covered the three. In regards to your M and W, um, it's simple. You know, the dynamic trend. Sorry, in regards to your dynamic trend line, which is the EMA 50 and the EMA 200, it's very simple. We're just looking for a bounce off of them. So the bounce would be where a couple of things. One, market goes, hits it, and then comes back down. And shortly after that, if there's a retest. Okay, the retest is like a massive confirmation. Yep. If there's a spike to the high and then the market's coming down, this spike by itself is enough of a confirmation this market's going to move down for a bit, right? And it did. Similarly with this one here. This one, yeah, moved up for a bit. Went all the way up here, right? Same stuff. Spike down, moved down for a bit. When we say a bit, I don't mean to say where you jump into a trade and you ride it for a number of days. I'm saying that this is an indication that you can jump onto a lower time frame to start looking for behaviors that happen on a lower time frame, so that you can possibly do a trade, ride your 20 to 30 pips or how much ever you're collecting. Let's just stick with 20 pips, right? So you ride and hit your 20 pips and you move away. The other thing that I like doing off the EMA 50 and the 200 on a higher time frame is to say, if I'm seeing a hit to the EMA 200 on a higher, on a daily chart for whatever currency pair, I will be careful of taking a long trade off of this on a lower time frame. So I might say, okay, here's a hit to the 200. I'm going to drop a line there. Let me get rid of this one. Jump onto my 15-minute chart, and that's my line. Okay, that's where my line has been. Would I instantly say, okay, I'm going to, because the market is here, would I take a short, or would I consider taking a long trade off just here because this is what the market's doing? No, I won't. Why? I'm going to be wary because the market actually has hit one of my dynamic trend lines, the EMA 200. So I'll be wary of that. I'll be like, okay, I'm going to watch to see what this market does over the course of the next couple of days. And this is kind of like your analysis on the macro level. We're painting an overall bigger picture. Okay, if you see something that's happening on the 15-minute chart, but a 4-hour chart or a daily chart or even an hourly chart shows you a strong signal that the market might do the opposite of that, and in this case, where the market has hit very close to our 200, we kind of just want to be wary of where price is, because chances are, say for instance this price was here somewhere and we're thinking market's going to go up, and the 200 EMA on a daily chart is only about 14 pips off, yeah, chances that we're going to hit a invisible wall up here, and that's exactly what's going on at this stage, is very, very high. Okay, so you always want to be able to jump onto a higher time frame quickly without applying too much stress to yourself. Do an analysis of where the market is. Is there an invisible wall that you can decipher on a daily chart? Okay, daily charted walls would be previous structure, and previous structure you use your horizontal lines, and again with previous structure I kind of just mean this. See this goes up, this is the structure. So what we can do is just drop a line at the bottom of this. If price comes up, and notice how wick to the high here, and look at where price is right now. It's very comfortably hugging previous structure. So if it's hitting previous structure, and with previous structure, this is a rule of thumb that what used to be a support area, once broken, will come back up and most likely be a resistance area. Okay, so the same point can be utilized as a support and resistance area. Previous structure will tell you that be careful around these areas because market may not do what you think it might do. Right, so I would draw that in. I would also look at where price is in proportion to previous moves, and in this case we'll say, yep, this behavior here from this point to this point was 61.8 move, and then we can possibly also just off of that say, okay, if this is market's been trending down, and if this is a W pattern, market is now establishing a new Elliott wave, then chances are we could possibly use our Fibonacci expansion tool and try and predict where this market could head in the future. All right. And again, watch the Fibonacci video if you're unclear with how to use the expansion tools. So in this case, what we're doing is to say, price hit the 61.8 mark and started to climb back up again. Where do we start looking for an entry? After price has reached this 100% line. Okay, once it's reached that, what we think might happen is price could go from here to 127, and we've got 86 pips there, and it could also hit to 1618. There's about 206 potential there, 206 pips. Okay, we're going to be watching the market over the course of the next few days to see if it's actually giving us some sort of indication that it's getting to that point. How do we also work out if that one, well, let's do this. The 1618 number is accurate for us of where the market could actually head to. How do we figure out if it's the 127 or one of those? Well, I'm going to drop a horizontal line at 1618. I'm also going to drop a horizontal line at 127, right? Remember, everything exists in proportion to everything else. So what I'm going to do now is I'm going to take my fib tool and I'm going to say, well, let's just say, for instance, I've missed something. I've been looking at these proportions here, but what if this move here is existing in proportion to this here? So the first thing I'm going to do is just play around with my fib retracement tool and say, is this retracing back to some point that I don't know of, right? So if I look from that point to this point, that high to this high, and this price movement back up, look at where price actually is right now. It's at our 61.8 line. Okay? We could then also say that I'm going to push this up to this high here. Where is price? Where would our 61.8 line be? It's very close to our 127 line, this first one here. So we could say if price does go up, chances are it may come to this point, right? So we can get rid of, we're going to keep playing around with this if you want to. We can also say, you know, is this a higher point? Where is the 1618? If this is a higher point, if this is a higher point, where is our 61.8 retracement? And we can say it could be up to these points here, right? So that's where you start playing with it a little bit and say, okay, there's every chance that if this continues going up, it's going to hit this and hit this. So what we do, we jump onto a lower time frame to see where that actually fits in. Okay, hold on. Let me get rid of this. Notice how when we jump into a lower time frame, that is just way too high for our purposes. So we then come onto a daily chart and we're investigating this move here. Okay, and we say, okay, how does this move all fit into our big move that we've just projected? Okay, you could probably do your fib tool and say, okay, this is where the market started to bounce off. I'll touch upon the 4 hits later on in another video. Actually, it'll probably get too complicated for this one. Market comes down, hits this line here. This is where we grab our fib tool and we're establishing. Market's pushing down. We're establishing a dynamic. Not dynamic. So we're establishing a horizontal support line. So in this case, we say, okay, price has come and hit 78.6, gone up, and it's done a retest to our 61.8 line. Okay, it's done a retest to our 61.8 line, and that's when we can say after this big move here, we can analyze this off a 15-minute chart, but we can enter a trade here and write it for 20 pips. Okay, and market does move up about 50 pips going into open of New York, but that's how you start to apply your support and resistance. I wouldn't do too much of, you know, where you jump onto a daily time frame and you start putting stuff all over the place. It's only in relation to where price is presently and a move that's happened previously, and you're utilizing this to predict. Well, I'll leave that there for a future point. You're utilizing this to predict where market's going to go to. Okay, and that's how you'd use support and resistance lines. Use your fib tool, use your EMA 200 and your 50, and also your trend line. It's not very difficult. You do it on a higher time frame, and then you're coming back into a lower time frame, especially an hourly chart and a 15-minute chart, to reanalyze the behavior of those. Okay, in the next video, I'm going to talk about proportions and levels, and we'll start putting all of this together, and I'll actually share with you some of my own little secrets of how I trade, and where the big king tides of impulse waves tend to happen, like meaning to say these big moves, where how do you know if that's about to happen, and that's how you trade it. Okay, I think that's it for this video. Okay, bye.